That's the power of reserves and keeping your money in reserves to where you can handle downturns. Because I don't care who you are, if you're in business long enough, especially real estate and investing, you're going to have stuff go sideways. And it's what options do you have to handle that will determine not only your success in that project, but your long-term success overall and whether or not you continue to grow or you go completely belly up.
This is your daily real estate syndication show. Today we are back again with our guest, Cowboy Joe. And I hope you listened to yesterday's segment where you heard more about his background in 08, 09, because that is going to lend itself into today's discussion. And ultimately, what he's doing today that he did, that he's doing different, right, from the way he did it back before 08, 09, and a massive, obviously, just crash and losing everything during that time. But he's going to talk through capital structures and debt, and equity, and how he thinks about those things. Again, whether you are passive or active, you're going to learn a lot from Cowboy Joe today. Cowboy Joe, welcome back to the show. Honored to have you back and spend some more time with you, because I know we're still going to learn a lot from your experiences, from 08, 09, and I want you to give the listeners again a little rundown there of what happened, but even more importantly, dive in what you were doing then versus what you're doing now, and how you're helping people to really change that what they're doing now. And so you went belly up to millionaire, multimillionaire, to doing it again. No doubt, so many lessons learned there. But I want to remind the listeners before we jump back in that we talked yesterday about Cowboy Joe's background and real estate development, and even to the point of 08, 09, which he's going to highlight again here, of going under, right, and to even homelessness, to the point of changing his mindset and focusing on different things, right, and jumping back into the business and making it again, but probably doing a few things slightly different, which I want to hear more about today. But welcome back, Cowboy Joe.
Thank you for having me back, Whitney. It's a pleasure, and I love educating people on this, and that's what my mission in life is. Like we've said, I was raised on a ranch. I knew the value of hard work, and basically the only way you can beat me is kill me, because you knock me down, I'm going to get back up. And 08, 09, it knocked me down hard. Like we talked about in the previous episode, I actually was homeless for almost a year and a half, and took a while to get back in the game. And then when I did get back in the game, it was a struggle, but that was the mindset side of it. But a lot of that mindset stemmed from the fear of what was the point of building it up if I was going to lose it. That's where I started learning more about the capital structures and protecting your assets to where you don't have that domino to where you lose everything. 08, 09, there was a lot of people out there teaching that you never have equity in any of your projects. You got to take the equity out immediately, roll it into another project. Money sitting in checking accounts was dead money. It had to be working. Well, nobody talked about opportunity cost. What's the opportunity cost of not having that money in your checking account? And learning the value of, okay, if I've got $1 million sitting in my checking account, I got other people I can go to and say, let's do this project. I can give them an equity position of 20 or 30% or whatever. And people are like, well, I can do it all on my own. Great. Yeah, you can. Let's say, all right, let's say you got $1 million. You can do a $5 million project, but you're going to be stuck doing that one project until it's completely done and you've exited out of it because you've put all your money into it. Whereas if you keep your money liquid to where you can qualify for additional projects and you bring in equity partners, all of a sudden now you can do $5 million projects. And so what if you gave 20% away? You gave away 5 million of 25 million, you still got $20 million versus the original $5 million project if you were stubborn and hard-headed as a mule and doing it all on your own, using all your own money. Here's the other kicker. If you use your whole $1 million in that project and something goes sideways, how do you keep it together? That's the power of reserves and keeping your money in reserves to where you can handle downturns. Because I don't care who you are. If you're in business long enough, especially real estate and investing, you're going to have stuff go sideways. And it's what options do you have to handle that is will determine not only your success in that project, but your long-term success overall and whether or not you continue to grow or you go completely belly up.
No doubt, no cash, you crash, right? I mean, I've heard it and seen it so many times now. Man, you got to have some reserves and speak to. Is there a way, Cowboy Joe, that you like to say calculate reserves or a certain amount that you have on hand? Or I get that question often a lot too, and I've heard it. I ask a number of guests on the show too. And it's like, just love to hear. How do you know what's enough, right? Whether it's personal or and for your business.
First is there's two other components to the capital structure. There's the debt side and there's the equity side. And 0809, they were saying, get more debt, get more debt, get more debt. And debt's great. It's great leverage, but debt increases the inherent risk of a project. Every project has a certain amount of risk. And each project you have to evaluate how much debt that project can carry based on the risk factors. And that's, a lot of people have heard of LTV, that's loan to value, but that's only one minor metric. There's a DSCR, debt service coverage ratio, and then there's also the BER, which is the break even ratio. Basically, those two numbers are how healthy is the project. Debt service coverage ratio is how much more is that project cash flowing and making than the debt service. And a DSCR of banks used to want at least a 1.2. They've recently changed and they want a 1.4, and which is great because I've typically built mine around 1.4 or better, because the higher that number is, the safer your investment is because you've got money in there to cover the debt coverage. The break even ratio is measuring the same thing, but in the opposite direction. How much does your project have to fall before you can no longer cover the debt? Banks usually typically want to see an 80% BER. I try to operate around 70% BER. That means that my project can drop 30% and I can still cover debt. Then the next thing is the equity. The equity is what balances out the debt and allows you to carry the whole project. Equity is you're giving a percentage of the investment or project to an equity partner. So they're taking on some of the risk with you, but they're able to participate in the upside because they have a percentage of the upside. And another thing, when you're evaluating debt, use something that's called a loan constant. A lot of people talking about lowest interest rate. Well, the lowest interest rate's not always the safest loan. There's a reason why banks promote a lower interest rate for a 15-year mortgage than a 30-year mortgage, because the 15-year is safer for them and puts more liability on you. When you actually calculate the loan constant, which loan constant is just the measurement of payments that you're making each year. That's both principal and interest. A 15-year amortized loan may have a higher loan constant than a 30-year amortized loan, although the interest rate is higher. And you typically want to go with the lowest loan constant because you can always pay more, but your obligation to pay is based on that loan constant. You can't pay less or the bank's going to come back and get it. So it's evaluating those metrics and then now getting into reserves. Typically, I like to have at least 6 months of reserves on a project, and reserves are what is your loan constant and what are the expenses if you have no revenue coming in for that. What are your hard expenses on that? That's like, are you still going to have a power bill? Are you still going to have trash service? You're still going to have taxes that you're going to have to pay, and making sure that you have those built in. And then taking your cash flow from that project and putting a percentage of it toward reserves so that ultimately you have a full year of reserves built up. And again, we're talking about longer term investments. Short term stuff, it's a different calculation. But when you're calculating long-term investments, and a lot of people is like, well, 6 months, there's no way that you need that much reserves. And then when you say a year, there's said, well, you can keep believing that, but Warren Buffett said, rule number one, never lose money. Well, if you don't want to lose money, you want to make sure you've got 6 months to a year of reserves. We just recently went through an event that I won't go into politics, but a pandemic that some real estate investors just experienced a year of no cash flow because their tenants weren't having to pay rents as per the government. So do you need a year's worth of cash reserves, or are you going to wing it on 3 months and hope you get by?
Right. Yeah. No, I love this, the thought process of how you got there, thinking through 6 months to a year, what that covers. I even as I invest more passively as well, it's one of my questions, right? How much reserves, do you have up front? Or, if you have a plan for a certain amount of reserves, how you getting there, right? Do you have it up front? Because often, they'll try to take it out of cash flow, or that's their plan, right? Or they'll get it some other way. But I'm like, wait a minute, what happens when this happens, and where's this capital coming from? So I love just how you have it planned out. I don't know, any other thoughts?
Well, you just brought up a great point. Typically, if somebody comes to me for money and all they focus on is what I'm getting as a return, especially first before anything else, I typically run for the hills. Uh, I'm more interested in how are you going to make sure you return my investment, ROFI versus RONI, return of investment instead of return on investment. How are you protecting my investment? And reserves are critical in that aspect. All right, tell me how you protect them. What are your alternatives if something does happen? Then tell me what is my return, because I could care less about what my return on investment is if I'm worried about whether or not I'm going to get my investment back to start with.
Yeah. Yeah. No, that's awesome. Yeah, it's some good. I just think about as I've learned more, just about investing in general. But as a passive investor, before knowing some of these things, I wouldn't have known to like ask about some of that. I wouldn't have known to like think through some of those things, years ago. And I think it's helpful for whether you're active or passive, listening. That you need to think through that as you're talking to an operator, or if you're an operator, you need to be able to answer those questions. But Cowboy Joe, what else about capital structures or balancing the capital, the equity, debt pieces that even today, as obviously so much is happening with debt and interest rates rising, thoughts around that, or as far as the capital structures for today?
That's the thing, there's tons of investors that get hung up on interest rates, the cost of the debt. I don't focus on what is the cost of the debt. I focus on, am I creating a spread? Now, true, the lower the interest rate is on the debt, the easier it is to create a spread. But it doesn't matter if you're investing in something that you've created a negative spread. It doesn't matter what interest rate you're paying. You can create a negative spread if you're only paying 4% interest on the debt. If your cap rate's 3%, you created a negative 1% cap rate or spread. Whereas if, let's say you've got a project that your debt's 15%, but if your project's making 25%, you've created a 10% positive spread. It's realizing that, again, the universe is always in balance, seeing both sides. Debt's only one side of it. You've got to look at both sides. And the whole key is creating positive spreads. That's the reason the banks have the biggest buildings in every city you go to. That's all the bank is in business is creating spreads. They take money in from depositors, they pay them one rate, that's their cost of money. Then they loan it out, and that's their money they're making on their money. They created a spread. They're not using their own money. That's another critical key. That's another reason you keep your money and you create spreads using other people's money.
Yeah, no, I appreciate even you breaking that down right there, what the bank does, right, and us thinking that way versus the bank. So no doubt about it. Cowboy Joe, what Do you have any predictions for the next 6, 12, 18 months, just in our economy, real estate market, things you're expecting? What I usually say on the show is that what we none of us have a crystal ball, right? However, what we believe does affect what we do, right, or what we're doing today. And so, what are your expectations for the economy, real estate market over the next 6, 12, 18 months?
One thing, I don't believe there is a quote real estate market. I believe there are many, many, many real estate markets.
Sure.
Some are overvalued and will see a big negative impact over the next 12 to 18 months. Some areas are undervalued and may actually see an increase where as people move from ones that are starting to drop into areas that they can see that there's still great cash flow in properties and that the cap rates are high, those markets will go up in value. I am preparing for a rocky year and a half, 2 years. I'd rather prepare for it and it not happen from a standpoint of just overall economy. Just some of the things that decisions that have been made financially at higher levels of government, we've eventually got to pay for. Something I taught my kids when they were young. Yeah, you're free to make any decision you want, but you're not free from the consequences of those decisions. It's a question of when those consequences are going to show back up as to whether or not when you're going to have to deal with them. And I think that the government has made decisions and kicked the can down the road to the point where the can's fixed to come back and start kicking back. And again, that falls under asset protection and making sure that you're structured to where you can handle that. And that's another critical component is the asset protection side of it and focusing on investments that can weather those times.
For sure. And maybe give us a snippet there on the assets that will weather those times. What are your thoughts about, I don't know, the assets that will weather those times?
A couple of things. One, and I know a lot of people are going to roll their eyes on this one, but properly structured insurance investment vehicles, infinite banking. And I emphasize properly structured with proper companies, but that's where you're able to get your money working in multiple places at one time. And that's something that can be your reserves that's continued to grow as well. And properly structured products with the right companies are one of the safest investments out there. Banks have failed, uh, but insurance companies, well, the ones we deal with are, I think the youngest one's 147 years old and paid dividends even during the Civil War. They still paid dividends. So one of the greatest turmoil times of our country, the company was still paying dividends. So to me, that's a fairly good track record. And then the great thing about it is it's continued to grow, but you're able to borrow against it and use that cash into other investments. I really think that the US dollar has some major headwinds ahead of it over the next year to 2 years. Uh, I still have some cash reserves just for emergencies, but putting a lot more into gold and silver and into Bitcoin. If you have not done research on blockchain and Bitcoin, and yeah, it's all over the news and the government's going to destroy it. However, every time one of the governments have tried to destroy it, it's gotten that much stronger and it's literally outperformed every other investment out there. I truly do believe that it is a hedge against inflation as well as a value asset to invest in, along with some more speculative plays in the crypto space, because that is the future. Is coming whether people want it or not. It's new disruptive technology, and the people that try to get in front of it and understand it are going to be in a completely different space than the ones that aren't. And then private equity in AI and Web3. Now, don't go all in on one company because of the promo materials. Use something that I like. It's asymmetric investing. Okay, we know AI is going to be huge. So pick 5 companies, do the research on all 5 of them, or do research on as many as it takes to get to 5. Let's put it that way. Let's say you wanted to invest $100,000. Well, put 20,000 in each one of them. All right. If one company 1,000X's, you don't care what the other four companies did. However, if you put all your money in one company and it went broke, you lost everything. But we know that AI is going to be huge over the next couple of years. We know that the blockchain is going to be huge over the next couple of years. And we know that Web3 is going to be huge. So that's three different areas that we know are going to grow. It's just a matter of doing your research and spreading out the amount that you want to put in each of those sectors.
All right, Cowboy Joe, a few final questions. What are some of the most important metrics that you track? And it could be personally or professionally.
The most important metric that I track personally is, who did I impact today? Who have I served? That's one of the reasons I'm very grateful for being on your podcast, is because I feel that I'm able to serve people and add value to people by being on the podcast. Even if you never come into my world, you've at least got one little nugget to think on. And when you think on stuff, you change your thinking. So if I can change one person's thinking and get them in a different space, then I've made an impact for that day. As far as metrics in business, it's, do I have things in a protected place? And am I continuing to take steps forward to continue to grow? Because every living thing on this planet is either growing or dying. There is no in between. So if you think you reach a certain point, you want to stay status quo, you can't do it. It doesn't happen.
What about some habits that you are disciplined about that have produced the highest return for you?
I'd say first and foremost is keeping my health a priority. People like, and I follow the carnivore diet, which is not for everybody. It's a pretty disciplined way to live, but I value my health more than I value biscuits and homemade cornbread. And I grew up on biscuits and homemade cornbread, so that one can be challenging. But the key is, it's again, it's balance. Every once in a while, I'll have a big chunk of cornbread with a big pat of butter on it, or biscuits and gravy, but that's the 10%. I pretty much eat for my health 90% of the time, and I'll have a drink with friends. Again, one or two drinks here and there, not going to impact your health. It's, what do you do daily? What are your habits daily? What are your actions daily that determine it? Same thing with working out. If I've got a demanding travel schedule and I miss a week of working out, then that's not a reason to stop working out. That's almost like you wake up and you got a flat tire, going and slashing the other three tires because you're mad because you got a flat tire. And then learning. I try to learn something new every day, and that falls under the growth. Is, am I growing or am I dying? Because you can't stay in between. And trying to keep my mind open to new ideas. Doesn't mean that I have to accept them, but I at least evaluate them with the other information that I have. And again, once you've been exposed to something, you can't go back. You evaluate it from a standpoint of, is it something you want to adopt, or is it something that doesn't fit you? And then focusing on paying myself first versus feeling obligated to pay everybody else. And that was one of the things that I did in 08, 09, that I paid every bill I had, and I would do it again. But realizing that if I had kept some money for myself, I could have built back quicker and been able to pay people back faster than I actually was able to.
Interesting. No, that's awesome. I just appreciate your level of detail and transparency and helping others now, and really learning from what you have done, right, and learned in the past and what you're doing now. And on that train of thought, how do you like to give back? I know you've mentioned it a number of times, but I always like to ask at the end of an episode, how you like to give back.
I don't give back because giving back, again, is a mindset. You're giving out of guilt. You feel guilty that you've got everything. I give out of gratitude. I love supporting entrepreneurs. I love supporting veterans, but I love doing it from a standpoint of challenging them at the same time. I like to give to organizations that are out there challenging them to put in the work themselves as well as supporting them. That's where you've got both the challenge and the support. And then I give to my organization because I have a nonprofit that teaches, and I fully believe in my organization. I give into people that work with trafficked girls. Anything involving women, spousal abuse, and there are men that are abused by their spouses as well, but predominantly it's women and children and our veterans. And then food insecurity. I give to local organizations that work toward food insecurity. That's the biggest thing is, again, how can we impact other people?
Cowboy Joe, grateful to meet you and have you on the show and really get to spend this much time with you, do 2 segments. Remind the listeners, hey, go back and listen to yesterday if you didn't, so you can hear more about Cowboy Joe's background and really story of 08, 09, things that happened there that I think is going to help you, right? As we're looking at moving forward, how Cowboy Joe's helping so many in the future because of the lessons he learned, right, in the past. But really today, breaking down the capital structures, thinking through the debt piece, the equity piece, and I mean, different parts of those parts of deals or projects that are so critically important. I feel like whether you're passive or active, you need to understand some of those things to a pretty good degree. And so just grateful for you elaborating on those things. Cowboy Joe, how can listeners get in touch with you and learn more about you? I know you have a boot camp coming up that you need to mention as well.
Okay. The best way to get a hold of me and learn more about me as well is my website. It's cowboyjoe.me, cowboyjoe.me. And there's a way to contact me there. I actually book 20-minute consult calls to see where you're at and where we can help each other or where I can help you. And then I do have a boot camp coming up where we do a deep dive on getting you to financial independence, creating your own personal roadmap to financial independence. And it starts with asset protection. The reason being is the brain's not built on abundance. It's built on protection first, then security, then abundance. So if you don't have your assets protected, your brain can't focus on abundance because it's continuously bouncing back to protection. Oh my God, I'm going to lose everything and that tiger's going to eat me because I lost my house. So again, it's focusing on protection first. And that's what the boot camp is built around, is creating a foundation of protection. And then, okay, now let's get to abundance. Let's get to where you are financially independent. And when I mean financially independent, I mean living the life that you're inspired to live, impacting others, not having to go to work for a paycheck. If you got a job you love, great, continue to do it. But you've got enough money coming in, you're not doing it for the paycheck. You're doing it because it inspires you and that's what you love to do. Then the minute that it doesn't inspire you anymore, you don't have to do it anymore.
Thank you for being with us again today. I hope that you have learned a lot from the show. Don't forget to like and subscribe. I hope you're telling your friends about the Real Estate Syndication Show and how they can also build wealth in real estate. You can also go to lifebridgecapital.com and start investing today.